On today's Hot Sheet, I'm discussing Jay Powell's housing-related statements from this week. He was at an annual meeting and had a lot to say. A Gen Z survey on housing affordability and a 17% annual increase in foreclosures. When did that happen? Did we miss it? What does it mean? Today is Wednesday, October 15, 2025. I am Byron Lazine, and the Hot Sheet starts now. Live from Naples, Florida. Pleasure to be with all of you today here on this Hot Sheet. Let me know in the live chat which market you're tuning in from, wherever you may be. It is an honor and a pleasure to be with you. We've got some Jay Powell commentary to break down. That's where we're going to start. So Jerome Powell this week, yesterday, in fact, was at the National Association of Business Economics, not the National Association of Realtors, if that's what you were thinking. NABE. It's an annual meeting. He dropped some new information. Okay, quantitative easing is coming to an end. That's the first. That's the bigger news economically. That's the macro news that Jerome Powell mentioned yesterday. There's been quite a bit of chatter around that. Late yesterday and even into this morning. So QT is coming to an end. And then obviously the housing comments, which we will break down on the quantitative ease, QT coming to an end. Listen, if you look forward on what this could mean and what it's already meant, 10 years actually moved down. You could make an argument, or you could certainly see a scenario where the 10-year does come down. If if the spread widens, right now we've had an improved spread. If the spread between the 10-year and the 30-year fixed widens, and obviously the 30-year fixed won't come down, but if the 10-year comes down, the spread stays the same. Well, then you're probably going to see 30-year fix potentially come down with this. Okay, so here's a tweet I'll bring to your attention. So Powell said we don't target housing prices. We have a large amount of MBS, mortgage-backed securities, and they're running off, but they run off pretty slowly. Powell reinforced the Fed would certainly not target MBS purchases to support the housing market. Those are some of the housing comments that we'll get into here in just a second. Logan Motoshami, friend of BAM, obviously friend of the Knowledge Brokers pod, said, hey, they don't need to do either as the spreads are almost back to normal. So if the spreads stay almost back to normal, even with ending QT, you could see these numbers come down, which is what we're looking for. Okay, we're looking for the 30-year fix, the 10-year and the 30-year fix to come down. That's what we're hoping for. That's what we're looking for right now. There is a pathway to that, but it's very much uncertain. It's up in the air. When you look at some of the feedback, and some really smart people are coming around to kind of what's been obvious for a while. This is Chamath Palihapitiya. Talking about QT is over. Now what? Probably rate cuts. Yet again, Powell behind the eight ball. The number of self-inflicted wounds by the Fed is piling up. I'm talking about that a lot. It was extremely late on acknowledging inflation. Now appears to be late on moving rates down. So there you go. We'll get into some of these housing comments here. Tightening suggests tightening program could end soon. Quantitative tightening, not quantitative easing. So going to end QT. Probably going to start cutting. I would imagine is what they're going to do. If you're not quantitative tightening, you should be cutting. This was at the National Business Economics Conference in Philadelphia. the Fed right now stands on ending quantitative tightening or the effort to reduce more than $6 trillion of securities it holds on its balance sheet. He did not provide a specific date for when the program will cease. He said there are indications the Fed is nearing a goal of ample reserves available for banks, so that the banks have the liquidity to keep the economy going. Our long stated plan is to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. So if you have the reserve, you don't have to keep pouring more into that, is essentially what he's saying. Okay. We may approach that point in coming months, and we are closely monitoring a wide range of indicators to inform this decision. Basically suggesting, hey, watch for cuts, as that Chamath tweet suggests. Most of the speech centered on the Fed's holdings of Treasury and mortgage-backed securities. Balance sheet questions are in the weeds for monetary policy. They matter to financial markets. Okay, so let's go to some of the housing commentary here. I thought this was quite interesting. If we go to really that first mention of housing, and this is about 17 minutes in. Bobby, if you want to go to this first mention of housing from Jay Powell at the NABE.
Purchases. Some have questioned the inclusion of agency MBS purchases given the strong housing market during the pandemic recovery. Outside of purchases aimed specifically at market functioning, MBS purchases are primarily intended, like our purchases of Treasury securities, to ease broader financial conditions when the policy rate is constrained by the effective lower bound. The extent to which these MBS purchases disproportionately affected housing market conditions during that period is challenging to determine. Many factors affect the mortgage market, and many factors beyond the mortgage market affect supply and demand in the broader housing market. With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risks.
Okay,
we knew that we could unwind.
So, years later, what did Powell just say there? With the clarity of hindsight, we could have, and perhaps should have, stopped asset purchases sooner. Our real-time decisions were intended to serve as insurance against downside risk. The downside risk towards the end, specifically, 2021, 2022, more so, when inflation was clear. It was clear to basically everybody except Jerome Powell, who continued to kind of gaslight us into, trying to get us to believe that it was transitory. Inflation is transitory. We've got this under control. What Jerome Powell and the Fed did was just pour a ton of gasoline on the fire at the end, which exploded inflation, which caused this reactionary impact on rates that had to happen at rapid speed once Jerome Powell came to the obvious conclusion that inflation needed to be dealt with. He came to that conclusion, if you recall, 8 days after President Joe Biden reappointed him as the Fed chairman, which now runs out in May of 2026. Now, it might be a coincidence, but the facts and the timeline are as such. Jerome Powell was reappointed and then 8 days later changed his sights on inflation. He waited for that reappointment. He allowed the new presidential administration a long runway of spending money that didn't need to be spent because COVID was already solved for. Now, I know we have the luxury of hindsight on COVID, but there was a lot of just obvious indicators that, boy, the economy is doing quite well. Think about this last statement. In hindsight, we could have and perhaps stopped asset purchases sooner. Interest rates wouldn't have been running at that 2.5% for that unnecessary 12 months that they were. 30-year fixed mortgage rates, I'm talking. If they were at maybe 3.5% or 4% or even 4.5%, how much difference would 6% make in the real estate market today? Now, we know Jerome Powell could care less about the housing market, but housing, the bedrock of the economy here in America, for most American families, their real estate that they own would have been in a much better position had rates not gone down as low as they did, and for as long, for unnecessarily as long as they did. If they were closer to a 4 or 6, wouldn't feel that bad. When we get into the 5s and 26, and you're talking about a bunch of people locked into 4 instead of 2.5, the market would have a lot more fluidity to it, a lot more flexibility. Prices certainly wouldn't have overheated as they did during that time frame. Let's go to the 26-minute mark. It talks about 12-month core, PCE, and then kind of where we're at today.
Of hiring difficulty continue their downward trajectories. Meanwhile, 12-month core PCE inflation was 2.9% in August, up slightly from earlier this year, as rising core goods inflation has outpaced continued disinflation in housing services. Available data and surveys continue to show that goods price increases primarily reflect tariffs rather than broader inflationary pressures. Consistent with these effects, near-term inflation expectations have generally increased this year, while most longer-term expectation measures remain aligned with our 2% goal. Rising downside risks to employment have shifted our assessment of the balance of risks. As a result, we judged it appropriate to take another step toward a more neutral policy stance at our September meeting.
All right.
There is
we'll get into some of the Q&A here in a minute. I don't agree with the data that Jerome Powell is pointing to. It's lagging data. It's obviously not coming in anymore because the government is shut down. But to say that PCE is outpacing the continued disinflation in housing services is referencing 1.5, 2-year-old data on housing services, when we know here in real time, if they use real time numbers, he'd be talking about quite the opposite, where the disinflation on housing is outpacing PCE inflation. He's got it backwards, which tells me, kind of to that Chamath tweet, he's going to be too late on recognizing where we're at once again. We have a question from Emily Kolinsky Morris. Bobby, go to this question here at the 32-minute mark if you can.
We're certainly in a volatile and changing environment. So one question I have is whether you see any changes in the transmission mechanism of monetary policy action. So when we speak of long and variable lags, as we do, are those changing? And in particular, do you think there might be any difference in the impacts of policy on inflation versus employment? Is one changing more than the other?
That's like 2 or 3 questions, so I might have to come back to you. That's right. So on transmission, there, in theory at least, I see 2 things. One is, what we say and the actions that we take on monetary policy and how quickly that gets into financial markets. So if you go back to when I was in college, that part would have taken, weeks, months probably. Now that part happens essentially instantaneously. But the rest of it, once it's in the financial markets, how quickly does it affect economic activity, unemployment, employment, inflation, et cetera? I think that's more dependent on the conditions in the economy. For example, if you take the group of people who had extremely low rate mortgages, right? And even so, if you can cut rates, but they're a long way down, and they're sort of in a place where it's going to be expensive to take out to take out a much higher rate mortgage, even assuming significant numbers of cuts. So that has probably blunted the transmission of lower rates into that part of the economy. But overall, I think it still works the way we think it works, which is, long and variable lags means a lot of uncertainty.
All right.
About it.
So listen, that group of extremely low mortgage rates is going to continue to create a chokehold on transactions in the real estate the real estate economy for housing for maybe years to come. When you give the gift that Jerome Powell gave to those who took advantage of, and there was a whole bunch, oh, you're buying too high. We all know those that got the 2.5%, 3%, 3.5% mortgages during that time frame made the purchase of a lifetime just by locking in that 30-year fixed mortgage rate. But when you give that many people that gift, you will create a chokehold of sorts on inventory in this country. Inventory will continue to kind of lag what a really substantial, normal real estate market should be. Unless you completely crater the economy, right? Unless the economy goes into some type of deep recession and deep job loss, then people are forced into a corner. But without being forced into a corner, you're not going to see that, that kind of turnover without time, because as Powell alluded to, even these rate cuts aren't going to get to a place where they're comparable to the low rates of that time, right? All right. Let's get to this last question, and then we're going to move to a couple other topics of the day here.
Back to the balance sheet, some questions. Again, I'll kind of try to group these together around mortgage-backed securities and housing affordability. Again, not directly part of the dual mandate, but would the Fed ever look at any specific actions with regard to MBS to address mortgage rates or affordability for housing?
The answer is, look, we look at overall inflation and we don't target housing prices. And also I don't know how you would, we would certainly not engage in mortgage-backed security purchases as a way of addressing mortgage rates or housing directly. That's not what we do. We do have, as I mentioned, a very large amount of mortgage-backed securities, and they're running off, but they run off pretty slowly.
So that's from the tweet earlier. That's the last housing-related comment. And for the 150th time, Jerome Powell stated it as clearly as he possibly can. He and the Fed have no interest in the housing market. It's not a mandate from Congress. They don't care about it. They don't focus on it. They don't create policy around what is good and healthy for housing market. And so some of the, decisions that they make, and some of the decisions and the timing that they make, especially if they wait too long on things, have adverse impacts on the real estate market. It put real estate into a 3+ year recession when you factor transactions and unaffordability. That was the hands of the Fed, nothing else. That wasn't institutional home buyers that put the housing market in this position. That was the Fed and the decisions that they made, and the ones that they solely made at the times that they made them. Housing affordability. Speaking of that, Realtor.com reports that it is a top life concern for 1 in 6 Gen Zers. 82% of Gen Z believe home buying is harder for their generation, and 16% rank affordability as the top life concern. Okay, 1/3 have started saving for a down payment. So 1 out of 3 Gen Zers are like, I want this and I'm saving for it. My actions back up my wants. 67% still see home ownership as a lifetime goal despite financial challenges. Interesting. People say a lot of things about Gen Z. One thing that I find is, Gen Z is an interesting group. When I was in that age group, I never knew anything. I didn't know a damn thing about politics when I was at the age of Gen Z. Gen Z ranges from 13 to 28. There wasn't a day during that period of time where I thought about politics, the macro economy, not really. And this group, they think about finance. They think about how that ties into the political conversation, the political moves. They think about the macro economy. They think about investing. They think about ways to invest. It's obviously easier for Gen Z than it's ever been in terms of ability to open up Robinhood and make investments, make bets, buy crypto, whatever the case may be. But this Gen Z generation thinks about things earlier than I would say almost any generation that is alive today. Okay. Now you may disagree with that. And I would just offer that you probably haven't looked deep enough at Gen Z. They have more information than any of us did. And Gen Z is looking at home ownership, and they're being realistic about the challenges they face. Now, there is a small, loud group on TikTok and on Instagram that is complaining about the unaffordability and whining about it, quite frankly, and saying, hey, the entire system needs to be torn down and it's everybody's fault. It's institutional home buyers, when we know that the stats, quite frankly, just don't back that up. That's a silly argument. That's a dumb argument. To say that people shouldn't be able to invest in real estate is also just a dumb thing to say. To restrict people's investments is not American, and it's not America. Go find a new country if that's what you believe. Restricting people's ability to invest is at its core non-American. Now, this survey from Realtor.com went through 1,000 adults, 18 to 27. So it kind of took out the 13 to 18-year-olds that currently own or hope to own a home. They found that 82% again find it's just harder for their generation to buy a home compared to previous ones. 16% say housing affordability is among the highest concerns. Career growth for Gen Z comes first. Career advancement ranks as the top milestone. 49.5% listing it first. I got to get a career. I got to get income coming in. Okay. Pretty good mindset. I got to get money flowing before I start investing. I don't know if you ever had this question, like, hey, I want to start making investments. And you like, look at kind of like what the person's making. And they're like, yeah, I got like $2,000 saved. I want what should I start investing in? Probably a way to make more money. That's probably what you should start investing in. Okay. Like, I'm not going to tell you to go spend $2,000 and buy, 18, stocks of something for, it's just crazy. So the oldest constituents, in Gen Z are at kind of a home buyer age, while the youngest, those under 18, of course, they're really far away from. So you got kind of a large gap here in this generation. There's a small gender gap in priorities. 52% of Gen Z women prioritize advancing their careers over other milestones compared to 45% of Gen Z men. Moreover, nearly 1 in 4 men ranked buying a home as their first goal versus 19.4% of women. So that's interesting, because I think the stats, what we've seen, in the millennial generation is women tend to buy a home before men, single men versus single women. We've seen that women in the millennial group anyways have gotten there first, have been more disciplined, financially disciplined, more organized, have been able to pull it off more so than single men. And Gen Z right now, as a goal, as ambition, men are saying, hey, that's a top goal ahead of the Gen Z women. So we'll see if the results actually flip as the ambitions lie. Okay. 46% of respondents feel at least somewhat ready to buy a home. Only 36% feel financially ready. Hey, Gen Z, the point about this is, and the reason I thought this study was relevant for the discussion, Gen Z is coming up, and they're definitely, Gen Z is definitely going to be a player at the table. Okay. No matter what you think about Gen Z, they're relevant. They're going to be relevant. They're going to be home buyers here pretty soon. They want to buy a house. They have interest in it. And so don't discount Gen Z. Okay. You can grab this inside of school, but this is kind of the full breakdown here. Which of the following tactics would you use, or have you already used to secure money specifically to down payment for a house? Okay, change where they work, take an additional job. People, hey, Gen Z's not working. There's a lot of Gen Z that are working incredibly hard. Borrow from parents or family. Move to affordable housing. They move a location. They move to Austin to be able to have this home ownership deal this become a reality. Take on roommates, ask for significant. And one thing I know about Gen Z, they'll ask for raises for sure. Not always going to get them if the skill set's not there, or the leverage, make riskier stock market or crypto bets. 28% would not do that. So as much as maybe the theme is, hey, they're taking risk, they're risk tolerant more so because of the access to the markets that weren't there from before. Well, 28% said they wouldn't do that, per this Realtor.com survey. Okay. All right, let's get into this foreclosure update and foreclosure activity. The headline's going to be scary, but the reality might lie a little bit differently. U.S. foreclosure activity increased annually in Q3 2025. The increase is kind of a big number when you hear it. It's 17% up from a year ago. Okay. It's up less than 1% from the previous quarter. And if you remember anything about Q2, it's like, hey, we're basically still under pre-pandemic levels. So we're only up 1% from Q2. That means we're still below pre-pandemic levels on the totality of foreclosures. Okay. There's a total of 101,000 plus U.S. properties with a foreclosure filing in the third quarter of 2025. The report also shows that about 36,000 plus U.S. properties with foreclosure filings in September is down 0.3% from the previous month. It is up 20% from a year ago. So the year-over-year numbers, 17% on the quarter, 20% year-over-year to the month, seem like big jumps, but we're making up ground from being at all-time lows, and we're still below pre-pandemic levels. In 2025, we've seen a consistent pattern of foreclosure activity trending higher, getting back to a normal rate. I saw in the comments here, we've got Frank and Tracy Murphy. Bobby, if you want to put Fort Bragg, North Carolina market, Frank and Tracy Murphy are expecting to see short sales and foreclosures ahead on just the unfortunate result of buying at that hot 2022, that ultra hot time when Jay Powell kind of poured the gasoline on the fire. There's not enough equity in markets which have had, building go on, downward pressure on prices, and they don't have much room to move. So expects to see an increase in short sales and foreclosures, as I do too. I expect to see an increase back to normal. This is expected, getting back to normal. Okay. Doesn't mean that we have a problem on our hands as it relates to foreclosure. States that had the greatest number of foreclosure starts in the third quarter are the ones that are building: Texas, Florida, California. Then you have Illinois and New York, which is interesting, but well behind the other two. And if you kind of look here at the line graph, where I'm at in 2019, yeah, 2019, yes, 2018, yes, 2017, all higher than where we sit today. So in fact, I not only expect this number to be higher year over year, I expect it to tick up going into next year, even if the market gets better. Yes, I expect it to go up. I do not expect it to be at the level in which we saw in 2020 and 2021, in the beginning of 22, when foreclosures were stopped, quite frankly, when rates were at the 2.5%, which have set up a lot of our problems of today. But if we had a severely shattered homeowner, okay, 41% of them don't have a mortgage. If we had a really vulnerable homeowner who really couldn't maintain the this number would be much higher than where it is today. We don't have that. We do not have a mortgage crisis on our hand. Worst rates for foreclosures per state would be Florida, Nevada, South Carolina. A lot of building, a lot of inventory. Where is it going to be harder to sell a home? States like this, particularly Florida. Going to be harder to sell a home in Florida than it is, right now in other states. Okay, it's going to be harder to sell a home in the Sunbelt states right now because there's such a bigger increase in inventory versus the Northeast or parts of the Midwest. And when you have more supply, that's what pushes prices down. Okay, that's what creates uncertainty on the price and the longer DOMs. Okay, and if you bought at that peak when Jerome Powell was trying to tell you that inflation was transitory, and you bought into that at the very end, you don't have much leverage, but you have the low rate. So if you hang in for 10 years, I think you're going to be quite fine, maybe even a lot less than that. Nationwide, 1 in every 1,400 housing units had a foreclosure filing in Q3. Again, Florida, Nevada, South Carolina were the worst. Here are the U.S. properties with foreclosure filings. Okay. So this is where we're at on filings, according to Adam, still well below pre-pandemic levels. This is the totality of foreclosure filings. We know that FHA is a little bit up. Here's completed foreclosures. If you were in the business back during the GFC recovery days, like I was, you remember this word, REOs. Hey, who's got the REO contract? Are you making an offer on an REO? Right? REOs. These are completed foreclosures. Not a lot. Okay, we're still at historically low levels, all-time low levels on completed foreclosures. A lot of properties are not getting to the finish line. Okay, a foreclosure filing doesn't mean that property is guaranteed to go into foreclosure. Certainly not with the built-up equity that most homeowners have today. The average days to complete a foreclosure is 608. So back in 2021 rather, that number was elevated. And it's come back down a little bit, back to basically, 2015-16 levels at 608. This is the lowest we've seen days to complete a foreclosure since 2016. One of the reasons that is there's not a lot of them. If we get a lot more foreclosures on the books, this number will go up. Okay. So not a lot of them happening. 608. Not a lot of, not a lot of employment around the foreclosure because we haven't had a foreclosure issue in obviously quite some time. Still here, recognizing we're up year over year. The big takeaway is recognizing that this gradual upward trend is just a trend back to normal. And this is what needs to be explained to those who are fearful or still have, foreclosure stressors because they remember back in the GFC days and they're worried that might come to bear once again. We're in a much different place. So we have annual increases, but overall levels remain relatively low by historical standards and below pre-pandemic levels. So long way to go before we're in any kind of issue there. All right. There you go. There is your Adam U.S. foreclosure update as it relates to Q3 year-over-year numbers as well as month-over-month numbers. U.S. Treasury coming in at 4.013 on the 10-year. So listen, hey, we've got quantitative tightening stopping. We've got probably now getting priced in that these, rate cuts certainly should be coming. This is the lowest level we've seen over the last 30 days. This is the lowest level we've seen in the last 90 days. So we know what this means. We should see more momentum 2 weeks outside of the FOMC, the Fed meeting happening. We should see more momentum. This is kind of where it picked up 2 weeks prior to the last Fed meeting. We saw momentum. We moved from 6.3 down to the year-to-date low of 6.11 or 6.13, I believe is where we hit there on that one beautiful day, 6.13 on September the 16th, okay, right before the Fed meeting. And then we kind of had some inconsistencies in the message from Jerome Powell shortly after, and we bumped back up into where we've been here now for weeks in this 6.3 range. Well, we're 2 weeks outside of the Fed meeting. There is a signal that you should see this rate cut coming. Maybe this momentum is getting priced in for multiple cuts. We saw a little bit of a move down yesterday, 6.31 on the 30-year fixed. We've got, after the Jerome Powell comments, in 14 days outside of the next decision, we've got a CME group saying 97% chance we're going to have this 25 basis point cut, 3.3% chance that there will be no cut. I find that hard to believe that that'll actually happen outside of some dramatic shift in the next 2 weeks, 94% chance on poly market, 2% chance that it's a 50 basis. So really in line on both measures that there will be a cut. In totality, 25 to 50 basis point. You have an 88% chance that there'll be a cut in December on poly market. A lot more uncertainty looking out to January on poly market, where it's a 56% chance that there'll be no change. So 2 more cuts at least expected here to close out the year. You'll start seeing that get priced in, and then we'll see where the momentum goes in 2 weeks when Jerome Powell makes the final decision along with the Fed committee members, and more importantly, does his Q&A at that moment. Yesterday's was interesting. That's putting in some momentum here. But the Q&A in 2 weeks will be ever more viewed by the markets. All right. Join me in just a week from the end of this week, next Friday, October 24th. I'll be in Denver. If you're in within a few hours of Denver, I suggest you getting over to this one. This is the Fusion Rally. I'll be delivering a keynote there on October 24th in the morning. So there's a link down below. Bobby will put it in the live chat as well. BZ25, use the code. If you're within, a few hours of Denver, this is like, you absolutely have to do it. If you got a short flight, definitely consider it. Love to connect with you. Doing a keynote there, October 24th, Denver, Colorado in the morning. Love to connect. Love to say hello. It's going to be a room of high-level operators. So, if you're really looking to grow, expand your business, the Fusion Rally in Denver on October 24th is really something to be at. All right. Huge opportunity there. A lot of top producers in the room, and I'm looking forward to being in Denver. All right. BAMX members, as always, all of your hot sheet data points are in the classroom. Just go to Classroom, whether on the mobile app or the desktop, go to the hot sheet. Everything that we use in the show delivered for you. So you want to deliver some of these, some of this foreclosure information, and you got 3 foreclosure starts, foreclosure filings, and completed. You circle pre-pandemic and you circle now. We're less than pre-pandemic. We do not have a foreclosure crisis on your hand. It could be useful charts to send over on one-on-one communication with those that believe that we're in it. Zudilio, our partners, who give the platform to every BAMX member for free. It's $2,400 value. Their platform helps you compete in any phase 1 marketing scenario, helps you generate 4 offers on every single property, compete with iBuyers, compete with phase 1 marketing to test pricing. Zudilio offers that to every single BAMX member absolutely free for just being a BAMX member. It's a free $2,400. We're paying you to be a part of BAMX. They also give us great data like this each and every single week. Top 10 housing markets for cash offers for the past week were Vegas, Miami, Naples, where I'm sitting today. Interesting. Houston, Raleigh, Fort Lauderdale, Atlanta, Phoenix, Dallas, and San Diego. There's your top 10 housing markets for cash offers. We know cash is how 41% of people own their home today. And the cash offers seem to be on the upswing right now, as I think some investors are coming back into the market right now. If you want to become a BAMX member, just go to school.com/BAMX, where you get access to not only the community, but all of our classrooms and a weekly content drop where you get weekly content each and every single week, hyper-local content delivered directly to you each and every single Friday. These posts are designed for you to customize, deliver to your social media audience. They're built by the same team here at BAM that builds all of our content, and delivered directly to you each and every single Friday, along with private consultations each and every single week. Today at 4:30 Eastern time, Chris Benjamin and Marie Lee are doing a authentic human content, create real connections with buyers and sellers conversation. So this is a office hours school session for BAMX members happening today, along with obviously all of our 9 a.m. role play masterminds and other office hour contents. Okay. All right. There you go. There is your hot sheet. I'm looking forward to being with you guys back here tomorrow morning. Have a great Wednesday. Until tomorrow, toodaloo.